Hello everyone, we are from Group 5. Let me introduce my group members. My group members consist of me, Tessa Laurencia, Takyudin Amri, and Rizkawati. Today we are going to present about Chapter 5 about analyzing investing activities, intercorporate investment. Let's start from the first slide. Investment securities. I believe that you all already know about what is investment. So, company invest asset in investment securities, or usually also known as marketable securities. Investment securities can be in two forms. It is either debt or equity securities. What is debt securities? Debt securities are securities representing a creditor relationship with another entity. For example, corporate bonds, government bonds, notes, and municipal securities. Meanwhile, equity securities are securities that is representing ownership interest in another entity. Example are common stock and non-redeemable preferred stock. Okay, now we are going to discuss about the criteria for classification and the accounting for each class of debt securities. So there are three criteria for the classification of debt securities. The first one is held to maturity securities, and then there is trading securities, and the last one is available for sale securities. I'm going to explain it one by one. Held to maturity securities are debt securities that management has both the ability and intent to hold to maturity. They could be either short-term, in this case, they are classified as current asset, or long-term, that are classified as non-current asset. Companies report short-term or long-term held to maturity securities on the balance sheet at cost. There is no unrealized gains or loss from these securities are recognized in income. Interest income and realized gains and losses, including amortization of any premium or discount on long-term securities, are included in income. The held to maturity classification is used only for debt securities, and you can see the more explanation in the table below. Second, trading securities. Trading securities are debt or non-influential equity securities purchased with the intent of selling them for profit in the near future. It is usually less than 3 months. Trading securities are current assets. Companies report them at fair value at each balance sheet date. Unrealized gain or losses and realized gain or losses are included in the net income. Interest income from the trading securities held in the form of debt, which recorded as it is earned. The trading classification is used for both debt and equity securities. Third, available for sale securities are debt securities that is not classified as either trading or held to maturity securities. These securities are included among current or non-current assets, depending on their maturity or management intent regarding their sale. These securities are reported at fair value on the balance sheet. However, changes in fair value are excluded from net income and instead are included in comprehensive income. With available for sale debt securities, interest income, including amortization of any premium or discount on long-term securities, is recorded when earned. Next slide, equity securities. So there are two main motivations for a company to purchase equity securities. The first one, it is to exert influence over the director and management of another entity. Second, it is to receive dividend and stock price appreciation income. So there are also classification and accounting for equity securities. First one, when the equity securities categorized as no influence, It means that the investor holding less than 20% holding in the stock. When equity securities are non-voting preferred, or when the investor owns less than 20% of an investee voting stock, the ownership is considered non-influential. In these cases, investors are assumed to possess minimal influence over the investee activities. These investments are classified as either trading or available for sale securities based on the intent and ability of management. Second, significant influence between 20% and 50% holding. An investment of 20% or more but less than 50% in the voting stock of an investee is presumed to possess significant influence. It can provide an investor the ability to exercise significant influence over an investee business activities. The investor account for this investment using the equity method. What is equity method? Equity methods require investor initially to record investment at cost and later adjust the account for the investor proportionate share in what investee income or loss because acquisition and decreases from any dividends received from the investee. Third, controlling interest holding of more than 50%. Holding of more than 50% are referred to as controlling interest, where the investor is known as the holding company and the investee as the subsidiary. Consolidated financial statements are prepared for holding of more than 50%. Analyzing investment securities. Analyzing of investment securities has at least two main objectives. The first one is to separate operating performance from investing performance. The operating and investing performance of a company must be separately analyzed. This is because a company investing performance can distort its true operating performance. For this purpose, it is important for an analyst to remove all gains or losses relating to investing activities, including dividends, interest income, and realized and unrealized gains and losses when evaluating operating performance. Second is to analyze accounting distortion due to accounting rules or earning management involving investment securities. Right now, I'm going to explain about the equity method accounting. Equity method accounting is required for intercorporate investment in which the investor company can exert significant influence over but doesn't control the investee. Equity method accounting is generally used for investment representing 20% to 50% of the voting stock of a company equity securities. Once the investor company can exert control over the investee company, consolidation is required. Accordingly, the equity method is sometimes referred to as a one-line consolidation. The primary difference between the consolidation and equity method accounting rests in the level of detail reported in the financial statement. Because the consolidation process does not affect either total stockholder equity or the net income of the investor company. Here is the example how to record the equity method. So assume that the global corporation acquired for cash a 25% interest in Mars Corp for $500,000. So to record this initial investment, the journal are investment in the debit and cash in the credit. Second, it is when Mars report net income. Mars is the subsidiary company. It report net income of $100,000 and pays dividends of $20,000. Global record its proportionate share of Mars earning and the receipt of dividends as follow. To record the proportionate share of investee company earning, then Global should calculate it by multiply 100,000 to 25%, and the result is 25,000. So the earning from the proportionate share in mass of global corporation is 25,000. And then to record the receipt of dividends, the calculation is 20% multiply 25. It is $20,000 multiply 25%, and the result is 5,000 with the journal, cash in debit, and investment in credit. So that's all my explanation, and the next material will be present by my friend.
All right, guys, I will continue the explanation. So the next is about the business combination. So for the business combination, that is refer to the merger with or acquisition of a business that they occur when one company acquires a substantial part of one or more other companies' equity securities. Business combinations require that the subsequent financial statement report on the combined activities of this new entity. Accounting for a business combination requires a decision on how to value the asset and liabilities of the new entity. This decision can involve a complete revaluation to market value of all assets and liabilities acquired, with substantial effect extending to the current and future financial statement. An analysis of business combination must recognize management's incentive, the accounting implication, and the need to evaluate and interpret financial statement of the new entity. Among the economic reasons for business combination are: first is acquiring valuable source of material, productive facilities, technology, marketing channel, or market share. Two is securing financial resource or access to them. Three, strengthening management. Four, enhancing operating efficiency. Five, encouraging diversification. Six, rapidity in market entry. Seven, achieving economics of scale. And eight, acquiring tax advantage. Okay. Business combination also can arise as a means to enhance a company image, that is perceived growth potential or its prosperity, and it is a means of increasing reported earning. Specifically, financial engineers can utilize method in accounting for business combination to deliver a picture of earning growth that is in large part illusory. The means to achieve illusory earning growth include: the first is merging a growth company having a high price earning ratio with a company having lesser growth prospect, and using payment in the high growth company stock. Then using latitude in accounting for business combination. This is distinct from genuine economic advantage arising from combination. Okay, next is accounting for business combination. Both US GAAP and IFRS mandate the acquisition method that is similar to the earlier purchase method when accounting for business combination. The primary goal of this method is to recognize the price paid for the acquisition of the balance sheet. This goal is achieved through the following two steps. First is all assets, tangible and intangible, and liabilities of the acquired company are recognized at their fair value on the date of acquisition, and the difference between the acquisition price and the fair value of the net asset of the acquired company is recognized as goodwill. In the future, depreciation or amortization is charged on all long-term assets with one key exception, that is goodwill. The goodwill is not amortized. Instead, it is subject to an annual test for impairment. Whenever the carrying value of goodwill is found to exceed its fair value, an impairment loss for the difference need to be taken and goodwill is written down its current fair value on the balance sheet. In the absence of such impairment, goodwill remains on the balance sheet as the original fair value. Okay, next is the consolidated financial statement. That is report the result of operation and financial condition of a parent corporation and its subsidiaries in one set of statement. A parent company financial statement evidence ownership of stock in subsidiary through an investment account. From a legal point of view, a parent company owns the stock of its subsidiary. A parent does not own the subsidiary asset, nor it is usually responsible for the subsidiary debts, although it frequently guarantees them. And the consolidated financial statement disregard the separate legal identities of the parent and its subsidiary in favor of its economic substance. That is, consolidated financial statement reflect a business entity controlled by a single company, that is the parent. Alright, we continue about the mechanics of consolidation. So first is the consolidation involves two steps, that is aggregation and elimination. The first is the consolidated financial statement aggregate the asset, liabilities, revenues, and expense of the subsidiaries with their corresponding items in the financial statement of the parent company. The second step is to eliminate intercompany transaction or reciprocal account to avoid double counting or prematurely recognizing the income. Also, there are several important points to understand about the consolidation process. First is the consolidated balance sheet include the book value of parents and the fair market value of subs as of the acquisition debt. That is less depreciation or amortization of the excess of the sub-market value over its book's value. The second is the consolidated income statement include the income statement of both parent and sub. The investment income recorded by parents on its books is replaced by the income statement of subs. In addition, the depreciation expense include the depreciation expense that subs record on the book value of its depreciable asset plus the depreciation of the excess of fair market value over books value recorded upon acquisition of the subs. Second, the newly created trademark asset is amortized over its useful life, resulting in additional expense. And the goodwill recognized in the acquisition is not amortized. And then the next point is the goodwill is only recorded after recognizing the fair market value of all tangible and intangible assets acquired. The companies are required to identify any intangible asset acquired. That is, intangible are deemed to have an identifiable useful life and are therefore subject to annual amortization. Okay, next is the impairment of goodwill. Goodwill recorded in the consolidation process has an indefinite life and is therefore not amortized. It is, however, subject to annual review for impairment. This review is a two-step process. That is, in the first step, the fair market value of sub is compared with the book value of its associated investment account on parent's book. The second step, if the current market value is less than the investment balance, goodwill is deemed to be impaired and an impairment loss must be recorded in the consolidated income statement. Okay, next is the issues in the business combination. The first is contingent consideration. That is, in some business combination, the parties cannot agree on a price. Therefore, they yield the notion of contingent consideration, where it is agreed that additional money will be paid by the buyer to the seller if the future performance goals are met by the combined company. Next is allocating total cost. Once a company determines the total cost of an acquired entity, it is necessary to allocate this cost to individual assets. All identifiable assets acquired and liabilities assumed in a business combination are assigned a portion of the total cost normally equal to their fair value at the date of acquisition. Next is gains on subsidiary IPOs. IPOs by subsidiaries are becoming increasingly common as companies seek to capture unrecognized gains in the value of their subsidiary stock holding, while at the same time retaining control over their subsidiaries. Next is in-process research and development. Some companies write off a large portion of an acquisition cost as purchase research and development, given the incentive to avoid recognizing EPR&D as a goodwill. Companies are alleged to value EPR&D as high as possible to increase the write-off and reduce or eliminate subsequent goodwill amortization. The next is debt in consolidated financial statement. That is, liabilities in consolidated financial statement do not operate as a lien upon a common pool of assets. Creditor, whether secure or unsecured, have recourse in the event of default only to asset owned by the specific corporation that is incurred the liability. Next is the pre-acquisition sales and income. When an acquisition of a subsidiary occurs, in mid-year companies only report their equity and subsidiary income from the acquisition date forward. Only net income of the acquired company subsequent to the acquisition date is included in the consolidated earnings. The amount of pre-acquisition income is likely to be deemed immaterial and included in other expense categories rather than reported as several line item. Then, next is the push-down accounting. Purchase accounting requires the asset and liabilities of an acquired company to be included in the consolidated financial statement of the purchaser at their market values. A controversial issue is how the acquired company report these assets and liabilities in its separate financial statement. The SEC requires that purchase transaction resulting in an entity becoming substantially wholly owned establish a new basis of accounting for the purchase asset and liabilities if the acquired companies issue securities in public market. The next is the consequence of accounting for goodwill. The excess of the purchase price over the market value of identifiable net assets acquired represent payment for super or abnormal earnings. That is, the residual measurement of goodwill give rise to the potential measurement problem. And if company do write off goodwill in the face of substantial losses by purchased subsidiaries, the timing of the write-off seldom reflect prompt recognition of this loss in value. An additional limitation of consolidated financial statement, that is, financial statement of the individual companies composing the larger entities are not always prepared on comparable basis. 2. Consolidated financial statements do not reveal restriction on use of cash for individual companies, nor do they reveal intercompany cash flow or restriction based on those flow. 3 is companies in poor financial conditions sometimes combined with financially strong companies, thus obscuring our analysis because asset of one member of the consolidated entity cannot necessarily be seized to pay liabilities of another. 4. Extent of intercompany transaction is unknown unless the procedure underlying the consolidation process are reported. That is, consolidated statement generally reveal only end result. Okay, last is the accounting for the consolidation of finance and insurance subsidiaries that is can pose several problems for analysis. Aggregation of dissimilar subsidiaries can distort ratios and other relations. Okay, that's all for me. The next will be discussed by my friend.
Okay, guys, so now I'm gonna explain to you about derivative securities. What is derivative securities? But before that, we have to know that companies nowadays are exposed to different types of market risk. This risk arises because the probability of business operation is sensitive to fluctuations in several areas, such as commodity price, foreign currency exchange rate, and interest rate. To lessen this market risk, companies enter into hedging transaction. So hedges are contracts that seek to insulate companies from market risk. The hedge is similar in concept of an insurance policy, where the company enters into a contract that ensures a certain payoff regardless of market force. Financial instruments such as futures, options, and swaps are commonly used as hedges. These financial instruments are called derivative financial instruments. So, derivative is a financial instrument whose value is derived from the value of another asset, class of assets, or economic variables such as stock, bond, commodity price, interest rate, or currency exchange rate. But however, a derivative constructed as a hedges can expose company to considerable risk. This is to the derivative contract fail to understand the potential risk from the instruments, or because the counterparty, this is the other entity in the hedges, is not financially strong. Companies also have been known to use derivative to speculate. Next. Now we defining a derivative. This is divided into three. A derivative of financial instrument are used for hedging activities. This is the three of that. The first, future contract. It is an agreement between two or more parties to purchase or sell a certain commodity or financial asset at a future date. It is called settlement debt, and at the defined price, future exists for most commodities and financial assets. It also possible to buy a future contract on index such as the S&P 500 stock index, like that. Second is swap contract. That is an agreement between two or more parties to exchange future cash flow. It is common for hedging risk, especially interest rate and foreign currency risk. And the last is option contract. Grants a party the right, not the obligation, to execute a transaction. Next. So this is the example of classification of derivative accounting. So all derivatives, regardless of their nature or purpose, are recorded at a market value on the balance sheet. This means if a derivative is an effective hedges, the effective of change in fair value usually should cancel out and have a minimal effect on the profit and stockholders' equity. Next, accounting for derivative. This is you can see this such a derivative terms. This is in how that in the balance sheet and income statement. You simply can post this video and read by yourself. You will totally understand because it's not something complicated. Next, accounting for derivative. The first is disclosure for derivative. Companies are required to disclose qualitative and quantitative information about derivatives, both in note to financial statement and elsewhere, and usually in the management discussion and analysis section. The purpose of this disclosure is to inform analysis about potential risk underlying derivative securities. Second, qualitative disclosure. Disclosure generally outline the type of hedging activities conducted by the company and the accounting methods employed. Many companies, for example, use derivative to hedge interest rate and foreign currency risk. The third, quantitative disclosure. This is my company often provide quantitative information related to its interest rate and foreign exchange hedging activities in the MD&A section of the annual report. The fourth is interest rate risk exposure. This is such a variable rate that company use to carry the lower interest rate than fixed rate debt, and in also taking on interest rate risk. Actually, in our book, this is such complicated to an example and that quite long. So maybe you can also read from our book to more understanding about it. And the last is foreign exchange exposure. Next, analysis of derivative. We have 4 points here. So the first is objective for using derivatives. In identifying a company, objectives for use of derivative is important because risk associated with derivative is much higher for speculation than for hedging. In the case of hedging, risk does not arise through strategic choice. Instead, it arises from problem with the hedging instrument, either because the hedge is imperfect or because of unforeseen events. In the case of speculation, a company is making a strategic choice to bear the risk of market movements. Some companies take on such risk because they are in a position to diversify the risk. This is in a manner similar to that of an insurance company, what I already said before. More often, managers speculate because of informed hunches about market movement. We must realize that many companies implicitly speculate even when they are suggest derivatives are used for hedging. One reason for this is that when a company hedges specified exposure, it does not always hedges overall company risk. Second point is about risk exposure and objective of hedging strategy. Once an analysis concludes a company is using derivative for hedging, the analysis must evaluate the underlying risk for company. The company risk management strategy, it is hedging activities and the effectiveness of its hedging operations. And unfortunately, disclosures currently mandate to do all provide meaningful information to conduct a true analysis. The third point is about transaction specific versus company-wide risk exposure. Company hedges specified exposure to transaction, commitment, assets, and liability, while hedging specific exposure usually reduce overall risk exposure of that company to an underlying economic variable. Companies rarely use derivative with an aim to hedge all company-wide risk exposure. Moreover, accounting rules disallow hedge accounting unless the hedge is specifically linked to an identifiable asset, liabilities, transactions, and commitment. The last point is about inclusion in operation or non-operation income. Another analysis issues is whether to view unrealized or realized gain and losses on derivative instruments as a part of operating and non-operating income. To the extent derivative are hedging instruments, then unrealized and realized gain and losses should not be included in operation income. Also, the fair value of such derivatives should be excluded from operating assets. This classification is clear for derivative instrument that hedges interest rate movement, since the underlying exposure, usually interest expense or interest income, is itself a non-operative item. For hedging of other type of risk, such as a foreign currency and commodity price risk, classification is less clear. Okay, next about the fair value options. It is for two fair value reporting requirement and fair value disclosure. For fair value reporting requirement, it is divided into 3 for information, this kind of this person's like kind of what we call as just nothing meaning to our matter. So the fair value reporting requirement, it is into 3 discussion. First, assets and liability eligible for the fair value option. So GAAP allows company to report a wide range of financial assets and liability on fair value. These include investment in debt and equity, securities, financial instruments, derivative, and various types of financial obligations. However, the following are not allowed to be reported on fair value basis, and even though they may appear to be in the nature of financial assets or obligation. They are, first, investment in subsidiary that need to be consolidated. The second, post-retirement benefit assets and obligation. The third, lease assets and obligation. Number 4, certain types of insurance contract. And the last one, commitment and others, equity methods investment under certain conditions. Second is about selective applications. So company are allowed substantially flexibility to selectively apply the fair value option to individual assets, liabilities, and this flexibility is allowed even within a specific assets class. For example, a company may apply the fair value option to certain available for the sell security, but not for others. However, once the fair value option is applied to a particular asset or liability, then it cannot be reversed. As it's about reporting requirement, if a company chooses the fair value option for an asset or liability, then the following reporting rules apply for the first. The carrying amount of the assets or liabilities in the balance sheet will always be at its fair value and measurement date. Second, all the change in the fair value of the assets, including unrealized gain and loss, will be included in net income. And third is the manner in which the unrealized gain or loss will be included is not specified. Second discussion about fair value is fair value disclosure. Also here divided into true by analysis, implication, as per here. First is reliability of fair value measurements. It is an important analysis task to evaluating the reliability of fair value measurement and their effect on the financial statement. Second is opportunity adoption of SFAS 159 and currently codified as SCC 825 to 1025 allows considerable discretion to companies in choosing the specific assets or liabilities for which they exercise the fair value option. An analysis needs to verify whether the fair value election has been opportunity with an aim to withdraw dressing and financial statement. So guys, this is the last explanation about our material. Thank you for your attention. And if you have any question, let us know. Thank you so much.